I'll be watching these sectors as things unfold and notifying people when trade opportunities arise. So make sure to follow and turn on the notification bell so you don't miss a thing. Also, head over to our website, www.markettradersdaily.com, and sign up for our newsletter to stay up to date with important news and insider opportunities. At 10 a.m. on a quiet Friday morning, the Supreme Court may release a decision that traders have been whispering about for weeks. Most investors think they know what happens next. If the court strikes down Trump-era tariffs, markets panic. Hundreds of billions in refunds blow a hole in the deficit. Stocks sell off. Chaos follows. That's the scary take. It's also backward. The real risk is not that stocks crash because tariffs are overturned. The real risk is that investors misunderstand where the pressure actually shows up next and position for the wrong problem. This is not a tariff story. It's a second-order effects story. The case centers on whether the president can use the International Emergency Economic Powers Act to impose broad tariffs without Congress. Lower courts already ruled those tariffs illegal. The Supreme Court is now deciding whether to affirm that view, limit it, or overturn it entirely. Prediction markets are currently pricing roughly 70 to 75% odds that the court strikes down or meaningfully limits the tariffs. There are three realistic outcomes, and each one rewards a very different group of stocks. Let's break them down. Scenario 1. Tariffs are struck down cleanly. This is the outcome most people assume is bearish. It's not. If tariffs are invalidated clearly and refunds become likely, what actually happens is a one-time transfer of cash from the Treasury back to corporations that paid those tariffs. That's a cash flow event, not an earnings collapse. In the short term, this is disinflationary and margin positive for companies that live and die by input costs. The likely market reaction, an initial risk-on relief rally. Import-heavy businesses re-rate higher, retail and logistics outperform. Some tickers that benefit include Costco, with high import exposure and exceptional pricing power, Walmart, a quiet beneficiary of lower goods inflation, Target, historically sensitive to margin compression, and FedEx and UPS, where cross-border volume expectations improve. Scenario 2. Tariffs are struck down, but remedies are kicked to lower courts. This is the messiest outcome and arguably the most realistic. The court rules on authority but punts on refunds, timing, and enforcement. That leaves companies litigating claims for years. Markets hate uncertainty more than bad news. The likely market reaction: volatility spikes. Indexes churn sideways. Stock dispersion increases. Cash flow certainty is rewarded. Some tickers that will likely hold up best include Microsoft, with minimal tariff exposure and dominant free cash flow; Alphabet, insulated from trade policy noise; Berkshire Hathaway, a portfolio of optionality in uncertain regimes; and Johnson & Johnson, defensive earnings with limited trade exposure. Scenario 3. Tariffs are upheld. This is the least discussed outcome and the most politically charged. If the court upholds the tariffs, the immediate effect is not panic, it's policy certainty. That matters more to markets than ideology. The downside comes later as inflation pressure remains embedded and rate cuts stay further out. The likely market reaction? Rotation out of rate-sensitive growth. Dollar strength narrative reappears. Domestic industrial beneficiaries outperform. Some tickers that benefit include Nucor, where the tariff protection premium remains intact; United States Steel, a direct beneficiary of continued trade barriers; Caterpillar, with domestic manufacturing and infrastructure exposure; and Lockheed Martin, where national security framing supports valuation multiples. Here's the real mispricing. The market is not mispricing tariffs. It's mispricing how long uncertainty lasts. Even if the court strikes down these tariffs, the administration retains other legal tools to impose trade barriers. That means the policy risk premium does not vanish. Margins still matter more than narratives, and cash flow certainty becomes more valuable than long-dated growth stories. The real edge is not the headline. It's what insiders do next. Court rulings create volatility. Insider trading reveals the companies who are best set to benefit from whatever happens. As this tariff decision plays out, tracking insider buying and selling activity across the companies most affected by each scenario becomes critical. That's where the real signal lives, not in the noise of the headlines. I'll be watching these sectors as things unfold and notifying people when trade opportunities arise. So make sure to follow and turn on the notification bell so you don't miss a thing. Also, head over to our website, www.markettradersdaily.com, and sign up for our newsletter to stay up to date with important news and insider opportunities.